Today's presentation is financial planning for business owners post-COVID. I actually done a similar presentation inside Republic of Work about a year and a half ago, and it's a pity we can't be there today. Look, I always love going in. It's a great atmosphere inside there, and the guys are great, but the world is very different. And I know everybody's probably a bit fed up given the recent announcements, and it's a wet and dreary day outside. So look, I do appreciate your time coming on today. Yeah, so look, as I said, today's presentation is very geared towards business owners, particularly, maybe those who are operating limited companies. And look, COVID or no COVID, the principles of financial planning are very much the same. If anybody has any questions throughout the presentation, I might just ask you to pop them into the chat section of the of Zoom. Look, and we'll do our best to answer it afterwards. And I might just ask everyone to mute their microphones as well, just to avoid any background noise during the presentation. So look, we'll kick on there. So just to give you an introduction to, I suppose, myself and ourselves first before we begin is, I suppose my name is David Looney and I work as a senior financial advisor in Alpha Wealth. We run a financial services company with offices here in Little Island in Cork, and we have a bit of a presence in Dublin as well as some other counties. And what we do essentially is we work with business owners like yourselves and individuals when it comes to things like savings and investments advice, pensions and retirement planning. And we offer advice and arrange various insurances like mortgage protection, income protection, business protection. And we do delve into many other areas like, tax planning where we can, mortgage advice. We are very much, a relationship-based business, and we try to, I suppose, maintain and create long-term relationships with all our clients. There's 6 of us in our offices in Cork and Little Island who are all, financial advisors. On the right-hand side there, you'll see myself and my colleague Nick in a photo with Dermot Bannon at an event that we sponsored last year. And I suppose the key thing about ourselves is that we are an independent company. We are not tied agents for any of the providers in the market. So I suppose I'd like to think that any advice we offer, individuals is I suppose, unbiased, and we've no vested bias in recommending one over another. But look, we'll kick on. So today's presentation, look, just to take you through the schedule of what we're going to cover today. I suppose the backdrop for this is that, we meet a lot of, business owners, and their companies might be performing very well and they're accumulating money in their company account, but they get quite frustrated because they find it quite hard to realize some of that in their bank accounts, obviously because Ireland has very high income tax rates. So for anyone who is already a high rate taxpayer and that you're earning over 36,000 euro per annum, any euro or extra euro you make or take out of your company, you will generally lose more than half of that to higher rate income tax you would see on pre-RSI. So, apart from jumping on a plane and moving to the UAE or the Cayman Islands or one of these places, there is a couple of things that we can do, and we would generally work with clients in some of these areas to, help them extract more money out of their business in a tax efficient manner, and help them use their business to pay for things, I suppose, that they and their family might benefit from personally, rather than them paying for these things from after tax salary. So the first thing we're going to look at today is wealth extraction and tax planning, obviously looking at kind of an end game for yourselves and how to get more money out of the company. Some of the things we look at here are obviously a company pension and company pension structuring, which is a very, very powerful tool. We look at how you can employ others, including your family. Obviously, coming up to exit planning, we will look at 2 very attractive incentives called retirement relief and entrepreneur relief. And finally, we look at a revenue-backed scheme called the Employment Incentive Investment Scheme. Moving on, then we're going to look at protection, so being prepared for the unexpected. And I suppose I'm coming at this from kind of 2 elements. The first is, as I said, getting your company to pay for things that benefit you and your family personally, rather than you paying for these policies yourself. And obviously, more importantly, is the protection side of things, making sure yourself and your business and your family is protected against the unforeseen. So we'll take a look at things like income protection, key man cover, shareholder protection, and finally we'll move on to growing your wealth. And obviously, this is very relative at the moment, given that we're in a period of historically low interest rates. So we speak to clients every day who maybe have money sitting in either personal accounts or company accounts. And they want to earn a better return on it, and obviously institutions like the banks and the post office and the credit unions are giving practically 0% interest for any money that you might hold with them. So from a kind of wealth extraction point of view, the first element that we will look at is pensions. And I know pensions can get a bit of a bad rap in our industry, and our industry does overcomplicate pensions a lot. But simply they are, just a long-term savings plan to plan for a time in your life where you won't be working. And I don't want to, paint a big pretty picture of retirement here for anyone, but it is it remains to be a very, very powerful tool for company owners in terms of getting more money out of your business and extracting more money out of it in a tax efficient manner. And if done right, pensions will be the most effective investment you ever do, if done right, of course. Now, the story here is, I suppose, most company owners will try to manipulate their salaries to avoid paying too much tax at the top rate. As I mentioned earlier, the standard rate cutoff for income tax in Ireland for a single person is about 35,300 euro. So for every euro you make north of that, if you are single, is taxed at nearly 50%. So you're losing more than half of that. If you are married, you can earn, typically up to about 45,000. So a lot of business owners, they will be, met with a bit of a dilemma. Do I take money out of my company in the form of salary and therefore lose half of it? Or do I leave it in the company account where it's going to be taxed as profits to corporation tax? Or option C is to put it into a pension. So you can towards the end of the year, if you have a bit of excess money sitting in your company account, I would recommend, obviously after you've enough for working capital and these type of things, to look at making a pension contribution, because that full amount that the company pays is, free of tax and arrives into your pension free of tax. And company owners or company directors have quite a bit of scope to, direct money from their company accounts into a pension account for themselves. And obviously that'll accumulate up over their working lives, which they can look to access it at retirement. So obviously you get tax relief on the way in. Any investment growth within a pension is tax-free, which really adds kind of rocket fuel to it, because you're getting, the power of compound returns over, 20, 30, 40 years in some cases. And once you hit retirement, you generally get to take out quite a generous tax-free lump sum from the scheme. Now, we'll just look down here on an example of, €1,000 salary increase versus €1,000 pension payment. And you can look at this in the context of maybe yourselves, or in the context of maybe a staff member who you employ. So if you're a high rate taxpayer and you take €1,000 from your company as a salary payment, after higher rate tax, USC and PRSI, what you receive into your hand is about €490, which is quite sickening. In the company's point of view, they will also have to pay employers PRSI, which is just over 11%. The company doesn't get any tax relief, as you probably know, for giving someone a salary, which makes the net cost to the company €1,110.50. So the employer gets about €490 on his €1,000, and the company is met with a cost of €1,110 to give this €1,000 salary increase. In stark contrast, if we look down at, if they were to instead put this €1,000 into a pension for, yourself or a staff member, the full €1,000 would arrive into their pension scheme, or your pension scheme, which grows tax-free until retirement. There is no employer PRSI on pension contributions, and they are deductible for company at corporation tax, or they get corporation tax relief at 12.5%, therefore saving €125. So the net cost of the company for giving this €1,000 pension payment is only €875 compared to €1,110.50. And the employee or yourself gets the full €1,000 into their pension. Now, we would recommend that if you have existing pension schemes, that you regularly review these as well, because we do, come across quite a lot of schemes that would have very punishing charging structures, or they're not appropriately invested. And, you can be putting all the money in the world from your company into a pension, which is great in theory, but unless your charging structure is competitive and, the funds are invested appropriately, you're fighting a losing battle. So it is important, as I said, to review your schemes on a regular basis, and we can indeed help you with this. Feel free to get in touch after, for anybody who does wish to look at this. And the second thing we're going to look at here is, how you can employ others through your business. and how you can pay people with benefits instead of extra wages, as we, slightly alluded to in the pension example. So you can employ your spouse through your company if indeed she isn't working, and you can pay them up to €26,300. So combined, both of you can earn up to €70,600 at the low rate of tax, which is 20%. So obviously that is very attractive, and that is why you will find that a lot of company directors will employ their spouse and have their spouse working in the company, because they can maximize how much income they can take in at the standard rate, which is 70,600 in this case. You can also employ your children from the age of 14, and you can pay them up to €7,800 a year tax free. So you can pay them €150 per week free of tax, which is also very attractive. You can, I suppose, they can pay for things themselves, obviously, from this tax-free income that they're getting, rather than you suffering tax on your own income and giving to them in the form of pocket money in that way. The third thing is obviously to look or explore the option of paying some of your staff in pension and protection benefits as well as salary. Like particularly if you have key staff, and particularly staff that are higher rate taxpayers. If you have a lot of staff that are maybe kind of in their 40s or 50s, for example, and they're higher rate taxpayers, like in the example earlier, if you went out to them and said, look, we can give you a €1,000 bonus, you'll only receive about 500 of that into your hand, or we can give you a €1,000 bonus and you can receive the full amount into your pension. A lot of them will opt for the second option, which is to get it into their pension, and that grows free over time, tax-free within their pensions. Now, when doing these type of things, it is obviously important, or very important, to speak to a good accountant. Obviously not one who just sends you an invoice at the end of the year, and one that will work with you, I suppose, to carry out these type of strategies within your business. So next, we're going to look at, I suppose, an end game for company owners, or an exit strategy. A lot of business owners will try to build and develop businesses. So maybe as they approach retirement, they can, eventually sell these businesses. And there's a couple of different things that you can do, or, vehicles that you can look at to maximize your tax efficiency under this type of structure. Obviously, one is a pension that we mentioned earlier. You can pay money directly from your company into the pension scheme. It accumulates up over your working life, and you can draw on that when you retire. There's two other very attractive reliefs that revenue grant to business owners. The first is called retirement relief, which allows you to sell your business if you are between age 55 to 65 for up to €750,000 tax-free. So you can essentially realize a tax-free lump sum of €750,000 between those ages for selling your business. And if you're disposing of your business to a child, you can actually get full relief, so the full amount is tax-free. The second relief is called entrepreneur relief, and this allows business owners to sell certain assets under their business up to the value of €1 million under a reduced capital gains tax rate of 10%. Now, usually when you sell these type of assets, you will have to pay capital gains tax of 33% on the gain. But in this case, if you qualify for this relief, you can realize that for a reduced rate of just 10%. So the potential savings for business owners are up to €230,000 if they're selling assets for €1 million. And you might ask me, what are assets? Assets essentially can be, your shareholding in the company, assets used in the business. Now, the key thing about these two reliefs is that there are a lot of terms and conditions that apply to both of them. There's, minimum hold periods, how long you have to be operating the company, and certain assets will be deemed to be qualifying assets or non-qualifying assets under either of these reliefs. So again, it's important to work with your accountant, and obviously, all these details are available on the revenue website for anyone who wishes to do a bit of research into them. The last scheme we're going to look at from kind of I suppose, a tax planning point of view is a scheme called the Employment Incentive Investment Scheme, or EWAS for short. Now, we will look at this in kind of two perspectives. Firstly, as a personal, I suppose, a personal individual, and secondly, from a company's perspective, or a limited director's perspective, a limited company director's perspective. Sorry. So what the EWAS is it is a revenue-backed scheme which allows you to invest money with a qualifying company over any 4-year period for a 40% tax rebate on your investment, in addition to a return from the company for the use of your money. Now, every year you'll see a lot of business owners or companies will try to raise capital through this vehicle, because for them it's a very cheap and efficient way of raising capital rather than, going to the banks. And for investors, the reason you would do this is to reduce your tax bill. So just for an example, let's say this year in 2020, you made an investment of 10,000 euro of monies which you had on deposit in your bank account in a qualifying company. We'll just call it company X in this example. What happens is in 2021, revenue will give you back 4,000 euro, which is 40% relief on the investment of 10,000. Essentially, they're giving you back the higher rate income tax that you would have suffered on this money, which makes the net cost of the investment just 6,000 euro. In year 4, 2024, in this example, company X will also return you your 10,000 euro, so your initial investment, plus interest, which is about 20%. So you'll get 12,000 euro back, which is 100% return on your investment of 6,000, or your net investment of 6,000. So outside of your pension and some of the other reliefs that we just looked at, it is a very powerful tool for, reducing your tax bill. And you can do this every year. And the minimum investments in these various companies are usually about 5,000 euro, and you can spread your investments over many different companies. You can also use the scheme as a wealth extraction tool from your company. So let's say you didn't have personal monies to invest in an EWAS investment, but you did have excess money in your company account. Let's just say that you took a 20,000 euro bonus from your company, and what you received into your hand after taking that bonus is 10,000 euro after tax. You can in turn put that 10,000 euro into the EWAS scheme over 4 years. And what you will realize out of that is 16,000 euro, which reduces the tax rate on the money you've taken from the company from 50% down to about 20%. So as you can see, it is a very, I suppose, powerful vehicle to get more from your company and reduce your tax bill. We have clients that do the scheme every year. And what it does is, I suppose, it creates a continuous stream of, reducing your tax bill and getting, money back in the form of the tax relief in year 1 and the return from the company in year 4. Now, a lot of the companies that apply to raise capital under the scheme are generally quite early stage companies, and some of them are quite risky. So it is important to pick solid companies. And as financial advisors, we would, I suppose, vet a number of companies every year, and we would generally cherry pick the top 2 or 3 that we would recommend as being, a viable option for our clients as an investment. There is, 3 companies that we are recommending this year, 3, very solid companies in our opinion. So if anyone on the call is looking to get a bit more information regarding the scheme or some, investments that you can do under it, feel free to get in touch with us after, and look, we're more than happy to discuss in more detail. So finally, look, moving on to, protecting yourself and your family against the unforeseen. As I said, I'm coming at this, from 2 points of view. One is that there are great advantages of being, a company director, and I will try to I appreciate maybe some people on the call might be sole traders at the moment, and they're not, operating a limited company. So I will try to relay some of this back. But there are great advantages in to going under that structure in terms of getting the company to pay for things that you would otherwise have to pay for personally. So if you are, someone who has a family and financial dependence, chances are that you would look to take out a life assurance policy, which will pay a lump sum to your family in the event of your death, to help, with living costs and educational expenses for your kids and these type of things. But there is a policy called pension term assurance, which basically allows your company to insure your life for 4 times salary. And if you die, there is a tax-free lump sum of that 4 times salary amount paid to your dependents or your wife or whatever the case may be, tax-free. Now, these premiums are tax deductible for the company, so it gets corporation tax relief at 12.5%. So what I'm saying is that for any business owners or company owners who are looking to put in place life insurance or are already paying for life insurance or life cover, there is more tax efficient ways to structure it, and this is one of them. Now, if you are a sole trader, you can also affect this policy, which is known as pension term assurance. So you can put an element of life cover in place for your family, and even though that you would pay the premiums from your personal bank account, revenue will give you relief at your marginal rate, be that 20% or 40%. The second thing that we look at here, and it's, I suppose, really overlooked by a lot of people, is income protection. At the end of the day, your income is your most important asset, and not a lot of people realize that. It's not your house or the money in your bank account, it's your income. So it's very important that you insure it. In my role, I see people insuring everything from pets to phones to TVs, but they often don't insure their income, which is the most important thing. So if you're a company owner, your company can insure your income or up to 75% of your salary through the company in the event that you can't work due to long-term illness or injury. And what that will do is, if you are out of work due to long-term illness or injury, it'll basically pay you your income until you're either fit to return to work or until you reach the benefit end age, which I usually recommend to be 65 to take you right up to retirement. Now, these premiums are tax deductible for the company, again, so you get corporation tax relief. So again, it's about, using your business to pay for stuff in a tax efficient manner. And again, for those of you who might be PAYE individuals or sole traders, you can also put in place an income protection policy, and revenue gives you tax relief on the premiums at your marginal rate of tax. The third thing we're going to look at here is, ensuring key people within your business. And sometimes it's really important to ask yourself what the effect on your bottom line might be if a key person in your business died or suffered an illness. And it is possible to insure against this risk. And it's something I would encourage every, business owner to do, or indeed look at, if they have these, key people in their business. And what it would do essentially is, in the event of that person, God forbid, dying, and I don't mean to be too morbid here, or suffering an illness, it would pay a lump sum to your business to help it, cope with any financial burden that might arise due to losing this person. And finally, we will look at shareholder protection, which is very, very important for those who might be in a partnership, or maybe, companies that have two main directors. Usually what happens is, if a partner dies, his or her shareholding will be passed to the family, which can cause a lot of complications. They might want to sell the business, or they might want to be involved in the business, which might cause a lot of headaches for the surviving partner. So what you can do is put in place a shareholder protection policy, which essentially pays out a lump sum to the estate of the deceased partner, and allows the surviving partner to take over 100% of the shareholding of the company, so he can continue running it, as he wishes, and the family obviously get, a financial lump sum to help deal with, I suppose, their side of things. So look, that's really, I suppose, some of the key things that I would encourage people to look at when it comes to, protecting yourself and your business and your family against the unforeseen, especially maybe as we venture into, quite uncertain times. So lastly, look, I just want to, discuss the topic of savings. As I said, look, it is very, very relevant at the moment, given that interest rates are, at historically low levels, which is great news for mortgage holders, but it's not great for people who are looking to get a bit of a return on their savings. And when I'm speaking about this, I'm speaking about it in the context of, both personal monies and indeed company monies. But for firstly, look, I will just talk about, personal monies. Obviously, if we can afford it, all of us should be saving, to build up a bit of a nest egg for ourselves, to build up a rainy day fund, to, fund large expenses down the line, like kids' education fees or something like this. And for any of these kind of long-term savings goals, unfortunately, at the moment, placing money in the credit union, the bank, or the post office is, in my opinion, a waste of time, because the returns are nil. And what you will find is that the value of your savings will be eroded because of inflation. Obviously, everything around us is getting more expensive. The price of goods and services goes up every year by, forecasted to be about 2% per year over the next couple of years. So if your savings isn't at least earning 2% per year, you are losing value. At the other side of the spectrum, you might find that, there are company owners such as yourself that might have some excess money in their company account. They don't want to take it out of salary, they don't want to put it to their pension, but it's just some excess money and it's not earning anything for them. There are, like, your personal savers, vehicles are options that you can use. And one of them is that I would recommend is to look at a accessible savings plan with some of the various life assurance companies in Ireland, like Zurich, New Ireland, Aviva. As a company, we deal with all of them. As I mentioned, we have no vested advice in recommending one over another. But one of my preferred plans in the market is a plan called the Easy Access Savings Plan from Zurich. A lot of my personal clients would use this for kid savings. They might put their child benefit or, even start a plan for themselves. And they can generally save from €75 per month upwards. They can stop it, start it back up again, increase the amount they're saving, decrease it, top it up with lump sums, or access the money at any stage with no penalties, which presents you, with that flexibility while making sure that some of your money is working hard in the background and it's not just sitting in a standard deposit account. Now, many of you might be wondering what exactly your money is going into. And it is essentially giving you exposure to some of the funds with these various companies, like Zurich, for example, and many of them would be ranked on this risk scale from 1 to 7. And just to put things in perspective, if you were someone who's maybe in your 30s or your 40s, a lot of your pension should be invested in risk level 5 and risk level 6 funds, because obviously you have time on your side, and the higher risk funds will generally get higher returns, and you can afford to take that volatility. And the notion would be that you'd scale it back the closer you come to retirement. But for those of you who might be wishing to look at personal savings and investment options, a lot of people might look somewhere middle in the road, maybe a risk level 4 fund. And what I'm saying is that fund would aim to achieve in the region of about 5 to 10% per year, but it could also lose in the region of 5 to 10% per year. And one of the things we do with clients is do, a risk assessment with them and speak to them about, their goals or their objectives for the savings and the time frame they have in mind, or their risk appetite. And a lot of this will dictate as to what fund they put their money into. Now, obviously, as an investment advisor, the key thing to bear here in mind is that over the long term, the market is generally moving in an upwards trajectory. Yes, we will have a couple of hiccups along the way, like, recession 2008, COVID, for example. But over the long term, if done right, you generally should get, a decent level of returns from these funds. Just to give you an example of what a medium risk fund would look like, this is a fund called the Prisma 4 in Zurich. And what it's comprised of is about 50% in equities, which are global stocks and shares. So, you're owning parts of the biggest and most profitable companies right across the globe, your Apples, your Googles, your Johnson and Johnsons, in a very diversified and spread out manner. It's in many different geographical locations, spread out in many different sectors. And the remainder of the fund would be things like corporate bonds, government bonds, and to a lesser extent, some property and alternatives. And this is typically looked after by a fund manager who's making decisions in the background to, mitigate risks and benefit clients. If there's particular areas that they don't like, they can reduce exposure and, in turn direct that to more favorable, sectors. But if you were to look at the performance of this fund, in a year where we've seen one of the starkest falls in markets back in March, where, financial markets as a whole fell about 30% in over the, just a couple of weeks. Now, a lot of them have recovered quite well since. But in a year which has been extremely volatile, this fund is up in value year to date, which is quite remarkable. And this is actually taken back in August. The fund is actually up about 4% year to date now, believe it or not. And what its average annualized returns are about 7% per year. Now, this type of fund is known as a multi-asset fund, and historically, multi-asset funds have never lost money over any rolling 7-year period. So with my regulatory hat on, I obviously have to say, past performance can't dictate future performance, and there is indeed risk involved, and I need to be clear of that. But for me, it makes sense, putting our savings and our pension monies in something of this nature, which has, and in my mind always will, deliver growth over the long term, rather than leaving it in things like bonds and cash. And again, look, we're more than happy to speak with anyone who might wish to discuss that a bit further. Just to wrap up, some of the other areas that we can advise on are things like mortgage advice for maybe those who might want a bit of help with getting on the ladder and getting geared up for a mortgage and navigating the various banks and interest rates, or even in those with existing mortgages and they're looking at ways I suppose save on their rate or switch mortgages. We can provide independent mortgage advice when it comes to things like that. We can also conduct protection reviews, not only on some of the various insurances that I mentioned earlier from a business perspective, but also health insurance, mortgage protection, life and illness cover. If any of you are paying these policies, firstly, we can look to see if it makes more sense to structure them through your business, and what are the tax savings in doing so. And secondly, we can just see, if we can bring down the costs of them, and obviously, give you a kind of, I suppose, an indication of exactly what you're covered for, and make sure that it's appropriate to your circumstances. Pension advice, obviously, as I mentioned, is very important, and it is important that you review your schemes ongoing and just get a bit of a health check or a second opinion on them. And we can do pension projections with clients to kind of give them some indication of what they might expect at retirement, to make sure that they're on track and help them meet any shortfall compared to what they're expecting at retirement and what they're actually on track for. And obviously some other things like succession planning and estate planning we can also offer advice on. So how you can reach us there is through the various social media channels like Twitter, Facebook, Instagram, and obviously our contact details are there. I know this has been recorded, and I know Republic Work, I think, are going to share the slides after the presentation. So look, if anybody has any specific queries, look, feel free to get in touch with us.